Hey, what's up, everybody? I wanted to knock out this quick video regarding assumable loans. On the forefront, it sounds great. You can assume a 3% interest rate. You don't have to get the quote unquote high rates of today. It's 6.8 or 7%. Long story short, an assumable loan does not benefit the seller. It benefits the buyer totally. So they're both going in two different directions here. So I'll start with the seller and then I'll talk about the buyer, okay? When a seller sells their home, they're trying to sell their home. They're trying to get out. They want their money, the quickest route possible with the less hassle, okay? And so by doing that, obviously they're going to list their home with the realtor. They're going to put it on the MLS. Hopefully they get a quick offer, and then, there's a 30 or 45 day escrow, or if it's cash offer, it's a quicker escrow, 15 days. And that's the best case scenario for the seller. Okay. Now, once they start talking assumable loan, that the seller is going to really have to bend over backwards to basically help the buyer do this, So why would the seller do that, and especially if the home just hit the market, because when the home just hits the market, that's when they're going to get their, their cash offers. They're going to get their finance loans and all that. So assumable talk is not even in the first, I'd say, month or two of that home going on the market. Now, that's typically how it goes for the seller, okay? Now, it doesn't favor the seller to go the assumable route because it's more of a, I don't want to say a headache, but there's more of a process. Sometimes assumable loans can take up to 6 months, and from what I hear, I think they're kind of adapted, and now they got it down to like a 45-day process. And so with that being said, let's switch over to the buyer. Now, for the buyer, obviously, it makes sense to assume the loan on the forefront. When people hear assumable loan, it sounds great on the forefront, but at the end of the day, you still have to qualify for that loan. It's not like you're just going to go in there and assume it. You still have to qualify. You have to have great credit. You have to have a decent amount of income, so you still have to qualify for that loan. And you better hope that loan's not a VA loan, because you may tie up the seller's entitlement with the VA, meaning that they potentially can't go buy another home if they go that route. So that's just another reason why listing agents, they don't entertain the assumable option at the forefront. So, it's great. There are times where this does happen, Obviously, if it happens, there has to be a willing seller and a willing buyer to make the transaction complete, obviously. But a lot of times it doesn't go that way. So for the buyers, if you can, hire a realtor, sign an agreement for a realtor, because if they're gonna be doing this work for you, there definitely has to be an agreement signed for them. You could, sign an agreement with the realtor, have them go out and find a seller that's willing to do that. I think it'd be difficult for a realtor to find that seller, but and the chances are that seller's not going to be on market. It's going to be an off-market property, potentially an investor that has, a home that they're willing to negotiate with. So, and that's what it comes down to, assuming loans. It's still a small fraction here in Las Vegas. I'd say 98% of the homes that are sold are either cash or a finance loan. So there's investors coming in here as well, but it's still a small market. So if you're a buyer and you're really keen on going the assumable route, you might want to consider seller financing. Seller financing, you can get your rate, your 3% right there. It's just seller financing comes down to whatever the buyer and the seller negotiate. So if you want to negotiate this amount of money down, If you want to negotiate this interest rate, if you want to negotiate this monthly payment, whatever the buyer and the seller figure out, that's seller financing. That's what it comes down to. Whatever, you two can agree on. But that's why I wanted to make this video. To basically, it's assumable loans. It's an option. It's there, but it's potentially one of the last options, especially if the home is listed on the market. And because the problem with assuming a loan is the buyer has to come out of pocket for the seller's equity, potentially as a down payment. So as an example, if the home is worth $400,000 and the seller has $200,000 in equity and then a $200,000 balance, that $200,000 equity, the person assuming it has to come out of pocket for that. And a lot of times nobody has $200K in their pocket. Now, if they're selling a house and they have that, then that can be possible, because the seller, they just want to take their equity and go, but, for the most part, that's possible. You could even possibly take out a HELOC to cover that, the equity, or there's even, you can do, the seller financing and, taking out a second loan to pay it off. But there's different ways you can make it happen. But on the 9 out of 10 times, it's, the seller's selling that house. They want a quick and easy process. And 9 out of 10 times, it's going to be a cash offer or a traditional buyer financing the home. So, but that's it. If you're interested in possibly, capitalizing on that 3% or 4% interest rate, because those aren't coming back anytime soon, what you can do is consider seller financing. So as an example, say you come across an investor or a person who owns, we'll say 3 or 4 properties. They're renting one out at, we'll say, roughly $2,000 a month. Okay. You could potentially, hire a realtor. The realtor can go to that seller and say, hey, we see that you're trying to rent this home out at $2,000 a month. It looks like you're trying to hold on to the property for 5-10 years. Would you be interested in seller financing it for $2,300 a month? And then we write up a contract, and once my buyer gets approved for the loan, a balloon payment of 5 or 10 years, would that be something that's possible? So you could always go that route, but I think if you're going to try to capitalize on a 3% interest rate in this market, it's going to be through seller financing, and that's only if the seller wants to do it. But that's our job as realtors. We talk to people. We have a buyer, we got to bring them to a seller. We have a seller, we got to bring them to a buyer. So if you found this video useful, like, comment, subscribe, comment down in the bottom. Let me know what you think about this video, what your thoughts are, if you agree, disagree, whatever the case may be. But the moral of this story, again, is that it doesn't really favor the seller. It depends on what route you go, but it's great for the buyer, but it doesn't favor the seller initially anyway. Take care.